Good morning, entrepreneurs. Today's lecture is the first lecture for 2017, and this is about close your business. What is the best way to shut down your business? So let's think about this case. You had been running your company for 20 years, and now you start thinking about the retirement and close your companies. But because of your hard works, the company had that 100 millions of the retained earnings. It's like the company's accumulated profit. So here's the question: how you should withdraw that 100 million of the company's profit to enjoy your life after the retirement? Depending on how you withdraw the money from the company, your tax amount you pay as an individual will change really a lot. So basically there's 4 ways to get a cash from your companies. The first one is company pay you a dividend. The second one is the company pay you as a retirement allowance. And the third one is you sell your shares, you sell your company to somebody else. And the fourth one is pay a directed salary in advance. Let me explain you about one by one. So the first case, the pay as a dividend, this is not really effective way to save your tax, because the payment for the dividend, receiving the dividend is subject to the comprehensive taxation. Let me remind you about comprehensive taxation. This is your income tax rate. As your income is going up, your tax rate is going up. So comprehensive taxation means that your dividend income and your salary income and the other income, for example real estate, they all combined together, and if the total amount of your taxable income is, and depending on your total amount of your incomes, the higher tax rate will be applied. But there is an exemption for the dividend. If your total taxable income is less than 10 million Japanese yen, you can get a 10% deduction for the dividend. And in case the total taxable income exceeds 10 million, that the calculation formula become different. Basically, you will get a less exemption for your dividend. Let me show you by example. The case 1, that your total taxable income is 9 million yen, and in that 9 million yen, your dividend is 2 million yen. So in that case, your total taxable income is it's less than 10 million Japanese yen. You can get 10% deduction. So if you receive 2 million yen as a dividend, you get 200,000 as an exemption. And case 2, if your total taxable income is 11 million Japanese yen, and in that 11 million Japanese yen, the 2 million is the income from the dividend. So in this case, we calculate 2 million yen minus 11 million yen minus 10 million Japanese yen, so which is 1 million yen, and 2 million yen minus the amount comes from A, it is 1 million, and 1 million multiplied by 5%, and B, 1 million multiplied by 10%, so you get 150,000 yen as an exemption. So the exemption rate become lower than case 1, which is 7.5% of your dividend. So if your income is going up, the amount you can get for the exemption is going down. So the second way is, I think it's most realistic way, pay the cash as a retirement allowance. Of course, that the real retirement allowance is subject to your income tax. but the favorable taxation rule, retirement, because there's a deduction according to the number of the years you worked for the companies, which is 400,000 yen per year, and also only 50% of your retirement income is subject to your individual income taxation. And the good things about is retirement allowance is subject to the separate taxation. So that means retirement allowance does not have to be combined with the other incomes. So that means your tax rate will not go higher even though the other income is very high. But you cannot, there's a limit for the amount of the retirement income. So there's no clear guideline for that, but if your retirement allowance is exceeding the reasonable amount, like considering your contribution to the companies, that exceeding amount will not be treated, that exceeding amount you have to pay the tax for it. So let me show you by example. Your company has a retained earnings of 100 million yen, and you worked for the company 15 years. So taxable income is 100 million Japanese yen minus 400,000 Japanese yen multiplied by 15, which is the number of the year you worked for the companies, multiplied by 50%. And this 47 million Japanese yen is subject to the income tax, your personal income tax. So approximately your income tax will be 16 million Japanese yen. So the effective tax rate is only 16%. In duality, most of the company adopt this method. So the third case is you can sell your shares to somebody else. What's good about this method is selling your share is taxed only like 20.315% for your capital gain, and this is separate taxation, so you don't have to combine the income with something else. And also how the capital gain is calculated: sales price minus acquisition cost of the shares. How much you pay to establish your company, and if there's expenses for selling, like for the security companies, you can deduct that amount, and that capital gain is subject to the fixed tax rate. So you have to think about which one is whether you should pay the retirement allowance or whether you should recognize the capital gain. Choose the lower tax rate. But even though you pay as a dividend and the retirement allowance, selling your shares, your company already pays the tax, corporate tax, and when you close the companies, you pay the individual income tax. So for the same income, you are paying two types of the tax, the double taxation issues. In order to avoid the double taxation, you can pay everything as a director's salary. So the director's salary is, if you receive the salary, that you have to pay the individual income tax, but director's salary is treated as the company's expenses. So you pay, in total you pay only individual income tax, and when you close the company don't have any cash and don't have any retained earnings, so there's nothing to distribute. That means you can pay only tax when you receive the director's salaries, and when you close the company you don't have to pay any tax. So you have to plan in advance when you start thinking about closing the companies. But you also have to think about the other issues. If your director's salary, like monthly salary increases, the social insurance costs will going up, And if your director's salary increases, you pay tax when you receive the salary, and you pay less when you close the company. So that means you are paying the tax in advance. So that will not be good for your cash flow. So if you start thinking about closing your companies, please talk with your tax accountant, and please call me. I can help your problem. See you next time. Bye bye. Thank you for watching my videos. I will make more and more useful videos this year too. So please subscribe and see you next time. Bye bye.